All right, welcome to today's Explainer. We're taking a really fascinating journey into the world of options trading today. And look, whether you're a complete beginner who's just dipping your toes into the market, or maybe you're an advanced trader looking to refine your income-generating tactics, you are absolutely in the right place. We're going to take what can honestly feel like a pretty complex derivative concept, and we're going to transform it into a crystal clear, step-by-step strategy. So get ready, because we are mastering the cash-secured put. Okay, let's just dive right into this, because getting paid just to wait, it kind of sounds like a financial cheat code, right? But I promise you it's really not. It's actually a highly legitimate, super widely used strategy. Think about it. Usually, when you want to buy a stock that you feel is just a little bit overpriced, you just kind of sit on your hands and wait, right? Your cash just sits there, completely idle. But what if the market actually paid you a steady stream of income, literally just for your willingness to wait for that perfect discounted entry price? Well, that is exactly the power we're unlocking today. So here's our roadmap for this explainer. First, we'll look at the paid-to-wait strategy. Then we'll get into the mechanics and the math. After that, we'll cover the risks and the Greeks, look at some advanced trade management, and finally, we'll bring it all together with the wheel strategy cycle.
All right, Section 1, the pay-to-wait strategy, redefining market entry.
So this strategy is honestly all about psychology. It's about letting the market come to you, which means you need a patient, really strategic mindset. Here's our working definition. A cash-secured put essentially means you're selling a put option, and at the exact same time, you're setting aside the exact amount of cash you'd need to buy the underlying stock if you're forced to. Think of the cash-secured part like putting money into an escrow account for a house you want to buy at a discount. You're proving to the market, hey, I have the funds ready to go. And by doing this, you collect an upfront premium. That's cash deposited directly into your account today, in exchange for taking on the obligation to buy the stock later if it drops to your chosen price. To put this into perspective, think about a traditional limit order. You wait passively, and your cash generates absolutely zero income. It's, frankly, a bit frustrating. Now contrast that with a cash-secured put. You're still keeping your cash ready to buy at a lower price, but you get paid an upfront premium to do it. It takes that passive frustration of waiting for a dip and completely turns it into an active, empowering, income-generating event. Moving on to Section 2, mechanics and the math, breaking down the numbers. Let's actually walk through the exact step-by-step process of placing one of these trades. First, and honestly, this is the most important part, you have to select a stock you genuinely want to own long-term. Second, you choose your strike price. This is your target buy price, and it's usually set below whatever the current market price is. Third, you sell one put contract to collect your premium. Keep in mind, one options contract always represents 100 shares. And finally, you set aside the total cash needed to buy those 100 shares. I can't stress this enough. Setting aside these funds is absolutely critical. It's exactly what prevents those nasty margin calls and keeps his entire trade highly conservative. Now, if you only remember one piece of math from this entire explainer, please make it this one. Your break-even price equals your target strike price minus the premium received. So for example, if you agree to buy a stock at $50 and you get paid a $2 premium to do it, your true break-even is actually $48. That premium isn't just nice income. It acts as a really vital cushion. It lowers your effective purchase price and literally reduces your overall downside risk. So the crucial point here is that this strategy creates a potential win-win scenario, provided, of course, you picked a good stock. If the stock stays above your strike price, the option just expires worthless. You don't buy anything, but you get to keep 100% of that premium. Now, if the stock falls below your strike price, you get what's called assigned. You are forced to buy the shares at your strike price, but you still keep the premium. And because you wanted to own the stock anyway, right? Buying it at a discount while collecting a premium on top of it is just a fantastic outcome. Okay, let's get into Section 3, risks and the Greeks, the engines and the brakes. I definitely want to address a common anxiety head-on here, because we need to be very serious about the risks. What happens if the stock absolutely crashes? Well, look, if the stock plummets way below your strike price, you're still legally obligated to buy it at that higher strike price you agreed to. On top of that, your profit on the trade is strictly capped at whatever upfront premium you collected. So no, you don't get to participate in massive upside rallies. You also have significant capital locked up as collateral, which naturally creates an opportunity cost. So ultimately, the risk here is very, very similar to outright stock ownership. If the company goes completely bankrupt, you're going to take a major loss. Now, to manage those risks dynamically, advanced traders use what are called the Greeks. You can think of these kind of like the dashboard indicators for your trade. Delta measures sensitivity to the stock's price, And as a put seller, you generally want the stock to either go up or just stay flat. Gamma measures how fast delta changes. It's what makes things swing pretty wildly near your strike price. Then there's theta, which is time decay. And finally, vega, which measures sensitivity to volatility. High volatility, or a high vega, is a bit of a double-edged sword. It means you get paid much higher upfront premiums, for sure, but it also means the stock is swinging wildly, which significantly increases your risk of assignment. But what's truly fascinating here is this concept of theta. See, as an options seller, time is literally your best friend. Every single day that passes, the option you sold loses a little bit of its time value, and that value decays directly into your pocket. Theta creates a massive structural edge for traders who are patient. You are quite literally getting paid for the simple passage of time.
All right, let's jump to Section 4, Advanced Trade Management, Beyond Set and Forget. I absolutely love this in-the-trenches insight from the Reddit options community, specifically this user named TJ Clausen. He basically explains that if you've already made 50% of your potential profit, it's probably time to close the trade. And why is that? Well, because the math completely shifts. If you hold out just to squeeze out that remaining $50, you're still risking your entire $1,000 of collateral to get it. The risk-to-return ratio just becomes completely skewed against you. Building on that idea, active traders employ a few tactical rules. They consistently close their positions early, usually right around that 50 to 70% profit mark. By doing this, they free up their capital really quickly so they can recycle it into brand new trades, which massively accelerates their annualized returns. Closing early also helps you avoid tail risk. You know, those super unpredictable, crazy market swings that always seem to happen right before an option expires. And hey, if a trade starts going against them, rather than just taking assignment, they might roll the option. That means closing the current trade and opening a new one down at a lower strike price and out to a later date, ideally collecting even more premium while giving the stock a little more time to recover.
And finally, Section 5, the wheel strategy cycle, the ultimate endgame. Let's see how all of this builds into just an incredible continuous system. Step 1, you sell a cash-secured put, and you collect income while you wait. Step 2, eventually the stock dips, and you get assigned those shares at a discount. Step 3, now that you actually own the shares, you flip the script. You sell what's called a covered call, agreeing to sell those shares at a higher price, which means you collect yet another premium. Step 4, the stock rises, your shares are called away for a profit, your capital gets freed up, and boom, you go right back to Step 1. You are systematically getting paid to buy low and then getting paid to sell high. But what makes this so powerful isn't just the income, it's the psychology behind it. As this quote perfectly summarizes, running the wheel, which always starts with cash-secured puts, really instills a resilient trading mindset. You stop chasing meme stocks, you stop gambling on hype. Instead, you become totally focused on a repeatable mechanical process. You actually learn long-term patience, discipline, and emotional control, and you start finding distinct advantages in both quiet and volatile markets. So, we've covered the mechanics, the math, the real risks, and the advanced tactics of cash-secured puts. You've seen exactly how transforming your idle cash into an active, income-generating tool can completely change your whole approach to the markets. The strategy's clear, the structure is in place, and the market is open. So, I'm just going to leave you with this final thought. You have the cash, you know the strategy. Are you ready to spin the wheel?